Okay, folks, how's it going? We are 4th of November 2022, and there is a lot of cheap stock out there. There's a lot of good stuff to look at, all right? And something that we talk about time and time again in the Discord, and that I talk about active on equities as well as futures, is investing. Now, I have to caveat, big caveat, this is not investment advice. This is simply me going to be talking about how I look at the kind of horizon of investing for myself and managing my money. And, if you're interested, you can give me a shout and we can talk, or you can, just reach out to me in the Discord. Okay. So, why am I talking about this? Well, it's really because there is a lot of really good value out there in the stock market at the moment. Like, you can get into really good dividend paying companies at a pretty good discount. We're about, I don't know what we're off on the highs, maybe 26% off the highs on the S&P for the year so far. So, let's jump over and really get into this now and, look at what we're looking at here. So for, investing, I mean, I've been trading equities for quite a while now, 18 years at least. And really, that's how I started off trading, was buying tech companies. And I suppose over the years, my frequency of trades has increased, and into day trading futures. But really, in the equity space, it's still buy and hold sort of strategy. So really, with investing, there's a lot to kind of talk about here. First of all, okay, so as we look at this here, really, with investing, there's a lot to think about. What sectors am I going to be interested in? Do I want to, what's my time horizon for this? Do I want to be cash flowing this month on month, quarter on quarter? Do I want to be rebalancing? Do I want to make cash on a frequent basis, or do I want to put money at play for a sort of pension fund strategy where it's over a much longer time horizon? And there are different things to apply, for these different kind of time horizons. So kind of, moving through this, really the starting point is, what do I want? What do I want to do? And that is, really going to feed into your time horizon as well. Do you want to be making, do you want to be making quarterly profits? Right? That's a question. And then if so, you should be kind of looking at sort of dividend paying stocks, dividend payers, right? Dividends. That's a terrible spelling there. Might make this pen a little smaller. Here we go. Right. You want to be looking at dividend paying stocks, okay? And you're going to be getting very close to the day trading world as well if you're going to be actively managing this, hunting down quarterly profits. But you need to be aware that you can't just bail into something on a Monday because it's got good dividends, and then you're going to get paid the dividends next Friday. It doesn't really work like that. You've got ex dividend dates and all that sort of stuff. Do I want a pension portfolio? Uh, portfolio. In this case, it's longer term. You want growth. You want growth and dividends. Okay, and then you could just be hunting for growth. So it's kind of 1, 2, 3. Okay. Now, I'm not going to be covering specific stocks in this chat. Okay. That's sort of something that is far more detailed than just jumping into a quick chat. Okay. So, do I want to go for growth? Well, if so, if you want to go for growth, you need to think along the lines of, what is cheap? Okay. And this here is what underlines exactly how I trade all the time, even in the day time frame. Is it cheap? Is it expensive? Is it going to get cheaper? Is it going to get more expensive? Okay. And so growth is one of the key things you want to look for when you're investing, even if you're looking for dividends. Okay. You don't want negative growth over a certain period of time, but if it's a marginal small amount of growth, or a small amount of negative growth, just through a small period, well, then maybe you're going to want to get into that as long as it pays a nice, healthy, fat dividend, and you have strong fundamentals, um, growth, or just looking for growth. And then we come to the Warren Buffett one, which is value. All right, and it kind of feeds into the growth mindset as well. What is cheap, But rather than you ask, is this cheap? You kind of say, well, is the stock, is it cheap or expensive? Cheap v expensive, relative to book value. Okay. Now there are lots of guys online who will teach you how to measure book value. What is book value? Essentially, book value is if I was to go into the company and liquidate everything that it owns on its title, all the computers, all of the factories, all of the assets. If I was to liquidate all that, how much is that? What is that value? What is that precise dollar value? Okay. And if you see something that, is trading severely under its book value, well, including say 5 years forward earnings, well then, maybe you want to buy that thing. All right. If something is trading 20 to 30x its book value, I don't think Warren Buffett's going to give you much for that company. So just to recap here, what do you want? And you have to think. Do you want profits on a regular basis? Do you want pension? Do you want the pension portfolio with growth and dividends? Do you just want growth? And then you're going to be trading a lot more frequently if you're just kind of looking for growth, because companies will go through growth periods and then contractionary periods. Like Netflix. Huge growth from like I think 2007 through to 2021, and then just comes through this contractionary spate where it just can't add as many subscribers as it had been while it was kind of moving into the Indian territory, and other kind of non kind of G7 territories, if you like, right? So really, that's kind of, these are the styles, and value, of course, being huge. Now, value, you need to be paying a lot of attention to the markets on a weekly basis, maybe not daily, but certainly you need to be really tuned in to the specific companies that you want to invest in for the value investment. And it can take quite a lot of time, for the market to realize that something is undervalued. And it can take a lot of time as well for the market to realize things are grossly overvalued. All right. And if you're buying low value, something that is cheap, you want the market to think it's cheap forever, and just keep buying and buying and buying, Unfortunately, like, I don't know, can I reference any companies? Well, the inverse was something that was very cheap, or thought to be very cheap all the way through 2020, 2022, is Facebook. High of 354, and the market isn't going to give you $90 for it today. What is the market giving you for it today? It's giving you $89.60 right now for a Facebook share. Okay, so what people perceived in 2020 through 22 was that $300 was cheap. Well, guess what? Right? It's not. Okay, so these are the kind of four things that you need to look at and be able to try and answer for your portfolio, right? And this is just kind of what I do. Um, Time horizon, then, kind of it kind of extrapolates out from the above there. What is it you want? Quarterly profits, obviously, you've got a timeline there. Pension portfolio, you've got a really long time horizon depending on your age and when you want to retire, or you know, then growth as well. You got to kind of figure out the timing using your edge in the market. You have to kind of figure out what is the timing for this company to actually grow both in size and therefore in value for me to get what I think is cheap at $89 on Facebook, and I do think it's cheap at $89. How long is this company going to take to grow to a point where I'll be happy with an exit? Okay. And then you think, well, maybe it's going to be 5 years, right? Maybe it's going to be 10 years before the metaverse is really pumping cash for that company, if ever. So maybe I want to go in there for like 10 years. Let's stick it in the pension portfolio for the growth. And I don't think Facebook are ever going to pay a dividend, but you know what? Maybe they need to, but they certainly can't afford to. Um, so coming on to time horizon, right? So say you know, if you're on that quarterly sort of investment buzz where you want to manage investments quarter on quarter, well, obviously you're going to have to break up your quarter into those 3 months, right? On the quarterly buzz, say for example, just look at it like this: you've got kind of blocks of three month blocks, right? And you're gonna want to be then utilizing the idea of what's cheap and what's expensive, and coming before you even come into the first quarter or when you start investing, you're going to be kind of at this point you're going to be what's cheap versus expensive, what's good value, what any interesting fundamentals or catalysts for the stocks you're looking at. Do you want to play FDA approvals on some very well established new companies and very established companies that have new drugs coming out? That's maybe a catalyst. Maybe there's a regulatory approval of some form waiting for, say, a car company that you're investing in. And so you want to have this investment done coming into, obviously, prior to these catalysts, for example, or you're prior to something trading into these cheap levels. Like in Facebook, we've been monitoring that $90 is actually a really nice area to get long the stock for us. This is not investment advice for anybody else, but this is what we're looking at here. I'm looking at personally. And so really, I know where I want to get active on this stock and hold it here and then hold it here and look for value appreciation over that quarter, and maybe over a longer time horizon. Okay. So that's one way of looking at it. Each style of investing, which is really, defined by what it is you want, will then have its own sort of time horizon, right? Obviously, the pension portfolio, we don't really need to talk about that. But certainly for the profits, you could be looking to gather companies that give you dividends over time that are actually in your pension portfolio. Okay, growth and dividend. Okay. If you're just looking, say, time horizon for growth, all right, we come down here and you just have the time horizon for growth here. We'll just going to take all this out of it. Really, that has kind of an undefined sort of time horizon, if you like, unless you have a catalyst that's going to drive that growth. So for say for the oil industry, okay, so if we're looking at for growth, right, well, we're looking at say in the oil sector, well, if I want to get into growth stocks, the subsectors are like, say, drilling, services, and there are separate companies within each of these, right? But invariably, what is the catalyst? What catalyst for growth? Sorry about the writing. And that is oil. Well, the answer is oil over say 100 US again. Okay. Or it could be invasion of Ukraine by Russia. Or it could be the SPR is drained to only 100 million barrels. Okay. So these can be your catalysts for then investing in, say, one of these companies or one of these subsectors, a company within one of these subsectors. Okay. But the thing is, you really need to define, what is your time horizon? If trades go wrong, you can't just say, well, I'll chuck it in the pension portfolio and forget about it. And a lot of people do that, and they don't really cut the losses, right? And then the value investing, right? For the time horizon on the value investing, well, really that kind of speaks for itself, and that the companies, if you're identifying something that's trading way below book value, you're really going to need to see that company create new products, reach into new markets, add new markets, or add a ton of subscribers through new markets, for example, and that will then over the coming quarters will well, once that happens over the preceding quarters, it will reflect on the value of the company, and then they'll be trading well, or should trade more and more and more above book value. So if we look at a say Amazon, for example, Amazon here, just here's the VIX, but if we look at Amazon, okay, and we go out to, this is weekly here, right? Gonna look at this real quick. You can see that I'll go out to just monthlies here, max monthlies. So I think it's back in we've had the split actually in Amazon, but essentially it's going to be quite hard to do this. But pre the split, when we were in about 2018, 2019, Warren Buffett had realized that Amazon had a book value of about $1,800, and I think that was indicative of about here on the split, since we've had the split, was about $70. Okay, at the time, and so that's how he invests. Okay, because something is trading way below book value on forward multiple earnings, he's going to want to wait in there and buy it until its share price reflects the book value of the company. And of course, look, COVID, no COVID, whatever, it was still a great buy. Well, always. And I still think it is. I mean, 83 pullback here, I think it's super cheap at 83s, by the way. That's just not investment advice. That's just what I think. And so, we're kind of getting a little bit away from, what we really need to focus on here, which is kind of, how to apply some of this money. All right. But getting to the meat of it, I really want to talk about, getting into the type of investment that you're doing, type of classification. All right. And then sectors. Okay. So this really is about, narrowing it down a bit more. Okay. You can't see the whiteboard. Okay. Let me just change that here. Okay, so we're just going to go back and have a look at time horizon on growth here before we move on to type and classification. Really, in growth, I've used the oil sector here. I mean, we could really look at lots of different sectors here, where, say for me right now, where I would see growth potential. Okay, so and this kind of tips into a little bit of thematic investing, like a theme which I've done a video before for the guys in Discord, is green energy investing, right? And that's the theme. What the theme is, that we're decarbonizing in the planet, and over the next 20 years, X, Y, and Z is going to happen. We're going to decarbonize, but that's going to be higher oil prices, not lower. All right, much higher oil prices, not lower oil prices. And there's going to be winners in the traditional large oil companies that are vertically integrated, which means that they extract the gas and oil and they also retail it into your home. But those guys are going to sideways invest into green energy, and they're also going to own that future as well. So, there's that's a theme of like growth. So maybe you could start off with growth. You'd look for a theme, right? So green energy, future. So what do we invest in there? Well, what's there to look at? BP, Shell, Chevron. There's ETFs of solar, ETFs, gas ETFs, smart grid, which there actually is an ETF called Grid, all this sort of stuff, wind, or, individual companies, not ETFs, but companies, right? It's all there to look at. SPOO's retest 3759s there, actually. So, that's one theme. I would argue within that there is a sub theme of electronic vehicles. So we look at, Tesla, Tesla, NIO, so on and so forth, right? Battery storage, right? Batteries in there, right, as well. But within this, what is the time horizon? Do you just buy all these companies at whatever price they're at right now? Well, I think there's a lot of good value across all of these companies right now, apart from BP, Shell, and Chevron, which are extremely expensive right now. But apart from that, I think there's pretty good value out there. But anyway, coming back to the time horizon, well, if you're on a growth strategy, you want to identify, has something had a significant pullback? I mean, I like Facebook. I like Facebook, right? But well, in terms of a company, I don't actually like using Facebook. But in terms of a company, I like Facebook. I think it's got a pretty decent book value, probably there, a business that it can point to, and I think say 89s is just very cheap, right? And I think in 12 months time, I think there's supports at 72s, right, as well. And I think in 12 months time, we should have, we're going to have 4 more quarters of earnings, and maybe the advertisers aren't going to be flocking back to Facebook so much over those next 12 months. Now, do I want to buy it or sell it? Because yes, it's cheap and there should be buyers at 72, but over the 12-month horizon, do I see 89 going to 300 and back, where everyone's forced to stay inside and look at Facebook, look at computers, look at their auntie posting pictures of a cake they just baked? No, I don't. So therefore, the time horizon for growth on $89 is actually unsure for me. So you know what? I don't like the investment that much. Now, do I want to get in on a quick lick, which is a different investment, buy 72s, buy 84s or 89s, whatever, and then sell it at like 100, that sounds more something like I would see being on the cards. However, the big question is well, if it breaches 72 support, is it going to go down to 50s? So I'm buying 72s and I'm going to have to buy it at 50s to then get out at 100s. Yeah, maybe. All right. So that's kind of the time horizon component for growth, you know. Now, this is more important, I think, than anything. Okay. Everyone kind of, you know, knows when something's going off versus when something's going to keep going up. The type of classification. Okay. So you can invest in startups. And if you are investing in startups, you should really stay in your lane. What you understand. Okay. If you're a carpenter, actually, a great one is a friend of mine is a tree surgeon and he invests in forestry. Okay. And that's a really good investment for him because he understands it implicitly and he knows what's going to have a great yield versus what isn't. He knows the time horizons involved. He likes that. He knows the yield that he's going to get. It's safe as houses, you know. If you're in the car business, you know, and you want to invest in someone who's invented a new EV battery, for example, that's staying in your lane. And that's it's startups. Really, you need to realize that 20% succeed and 80% fail. Okay. So what a lot of startup investors do is they invest in 10 companies. 10 companies. And the 20% pay off all of the losses on the other 8. Now there are funds that do this for you. I know a lot of people in this space, and really there is nothing like the returns that you will get on private placement of money and like capital placement in startups. You're talking about, you know, you can do 3,000% on some of these things, you know, depending on the exits that they go for. But that's really pie in the sky stuff if you're not in that space and you're not very familiar with the industry that you're investing in and the startups and how strong those startups can be in that industry that you're investing in. And there are firms that this is all they do, venture capital firms. That's all they do is just look at this and they spread their money across those 10 companies and then they're ringing the bell on 20% of them. Sometimes, in a best case scenario, they'll make the money on 30% of them. They'll have 3 exits. So, you know, is it startup money that you're putting in? And you're going to have to go and find those companies and you'll have to write up the share documents. It's not like you can just wade into the private markets on a chart, you know, like on the CME or the NASDAQ and just buy it, you know, because this is before obviously IPO. Okay. So, but the most regular sort of way to do this, to invest, is to buy shares and stuff and whatnot, you know, on your exchange. And or you could, you know, there's lots of things you can buy. A startup, you know, invest in a startup. You can invest in an ETF, which is one way, you know, it's going to be a grouping of companies within, like, you know, Grid is an ETF. Okay. And that is smart grid tech companies for solar. There's solar companies in there. There's logistics companies, or sorry, not logistics companies, but kind of, you know, people organizing and maintaining and putting in this smart grid technology. You know, so there's all grouped into one. So you can buy ETFs. Some of these ETFs will pay dividends. You know, you'll get dividends out there. Okay, that's one way to get exposure to a large group of companies, and you'll only get charged like 2% management fee on the ETF, or maybe 1.5 or 1.1, depending on what the ETF is. You could buy an ETF, you can buy bonds. What else can you do? These are the main ones that I would really recommend. Or obviously you buy stocks. Stocks, some pay dividends. Some pay dividends, some don't. And I would suggest that you go and research, just do a stock screener on the market and see which are the highest dividend paying companies and which have been paying healthy dividends over the last 10 years. And that's really going to get you into some interesting companies that will be safe places to put your money. I think, again, this is not investment advice. I'm not telling anyone what trades to take. I'm just kind of making this information a bit wider available to people. Stocks, dividends. So let's say, we want dividends in, we think oil and gas is going to go great, right, over the next 10 years or 5 years. And I think it will. So we want something that pays dividends in the oil and gas sector. Okay, so we can narrow that down using Schwab UK account, Schwab US account, Schwab Global account, First Trade. I'm sure there's lots of software or broker providers in the UK and in the US for sure, who offer those screeners, and you simply go in and filter all the stocks in the available markets you have for dividends. And then you really want to see if these companies are paying, have been paying dividends on a regular basis over a long period of time. Obviously, through COVID, a lot of companies cut back on dividends, and now they're just getting back to issuing back to full dividends again. But something to be aware of is, like in REITs, for example, you could invest in a REIT, a real estate investment trust. A REIT, real estate investment trust. But you want to be careful here, because you can put money into a REIT and you're getting paid your dividend, like monthly or quarterly, right? As the year goes by. And then you go in and you look at the chart, and the value of the REIT through the year has just gone down. So while you're getting paid your 20 cent a share dividend on the monthly, you've actually probably lost like 20% on your investment over the period on your capital. All right. So that's not good. Okay. You don't want to see the actual underlying that's paying you out your dividend going like this, right? So that's one thing to be aware of. Okay. So, that's your type classification. So sectors, yeah, I mean, we kind of talked about sectors, is it oil and gas or energy? Is it energy? Could be energy. Could be warehousing, which I think is a really great sector. Could be technology. Technology, and within technology, it could be telecom, or it could be Web3, or it could be security, right? And you could invest in multiple companies within these subsectors here. Okay. Could be EV, so on and so forth. Okay. So it's pretty obvious stuff. Okay. So really, again, before we get on to what's the edge, let's kind of go through this top to bottom. Okay. So there's really, you want to go in knowing what you want out of the investment. Do you want to just build a nice stable of companies that really are going to be, you're looking for growth and dividends? You know, then if it is, you probably don't want to put Facebook in there, because while it may grow from $89, it's not going to pay you a dividend, you know? Whereas if I own PAA or BP, it's going to pay me between 7 and 11% dividend annually just for owning it. And there's going to be growth in the value of the stock. Okay. So, really important there, really important. So then the type of classification, maybe you find a startup that's in the green energy space and you understand that space very well and you can manage to get a private placement of money in that company. That would be phenomenal, or maybe there's a green energy ETF that you like, or you like 10-year US 10 years right now because the yields are rising big time, and you're going to be able to get, like, I don't know, 3% plus on US 10-year. Okay, well, 3% is good, but 11% is better, and you can get 11% out there. Okay. Stocks, again, stocks that pay dividends. REITs, yeah, just be careful. Maybe there's a warehousing REIT that you could get involved in. That sounds great, right? And so, really knowing the sector you want kind of is then where you really start to narrow it down as to what you're trying to do. And then what is the edge? Okay, so this is kind of the biggest question that gets asked of people who are newer to trading all the time. What is the edge, right? I like the stock isn't really an edge. Okay, what is the edge? Okay, so there's multiple ways to look at this. You can just go on pure technical analysis. And I would say that is support and resistance. Very basic stuff. Yeah. So, Facebook, 354 up here, 90 here. The stock is kind of something like, and it's going to come down to, say, this former high. All right. And we like it because it's oversold here, maybe, and we're looking for a bounce to here. All right. That's just super technical analysis. All right. The former high here being played again here. Simple, right? Pure play technical analysis. Or you go with you go with value. Okay. So what is cheap? Be expensive. Well, how do we measure cheap versus expensive? Well, we have a very precise way of measuring it here in Duggan Capital. But for, there's also the Buffett way of doing that, which is, book value. We measure by book value. Or we measure by forward earnings. Or the PE ratio. All the price to earnings ratio, all these different ways of valuing cheap versus expensive, right? What is the edge? Maybe you're using a moving average edge. This is another very common, the 50 EMA crossing over the say the 200 EMA, right? Is bullish, and the inverse is bearish, right? That's very simple edge for investing in stocks, for example. So yeah, I mean, that's kind of summing it up, really. Once you can answer these questions of, like, what do I want? What's the time horizon? Do I want to do it in a startup? Do I want ETFs? Do I want bonds, stocks, REITs? Do I want a bit of all of these? Do I want to invest in 10 different startups and then, have my bigger chunk of change in ETFs? or in a handful of stocks. One of the guys, Kurt, was sent me a message this morning and saying, I talked about this with Jason Shapiro as well recently, is that, the 60-40, 60% stocks, 40% bonds, it's absolutely tanked and underperformed this year. And really over the last 10 years, I think, looking at, 2 years anyway, it's really tanked as a method. So maybe, you just want to go for pure play growth and dividends, or pure play growth. Maybe you want to invest in crypto. Well, crypto will react anyway, in a similar way that the stocks will, or an ETF will. You could buy a crypto ETF, for example. But you guys can go out and pick from all these different sectors and see, does this sector have a future, and do I want to be part of that future? And then what type of edge do I want to employ? Normal technical analysis. Do I want to dive deep into the balance sheets and look at cheap versus expensive? What's the book value? Is it undervalued? What's the price to earnings ratio? And then, maybe you want to use just some moving averages to time your trades. Anyway, I'm going to leave it there. Thanks for tuning in. If you have any questions, just send me an email, tim@DugganCapital. And listen, have a great weekend. Talk to you later.